Welcome students again. This is Samuel N. Muchai, your accounting lecturer in Accounting Made Simple. Accounting Made Simple. Today I want us to study a topic I call the accounting equation. The accounting equation, and in accounting equation we say that assets equals to capital plus liability. What are assets? In a business, assets are resources. Assets are resources. Assets are the things that the business controls. They are the things that the business controls. They are resources. And then we always say they are equal to capital plus liability. And this is funding. This is funding. This is funding, the sources of funds, the sources of funds. Now this equation is based on an accounting principle which we call separate entity principle. Separate entity principle. What is separate entity principle? In separate entity principle, we say that the owner and the business are two separate persons. The owner and the business are two separate persons, and anybody else. So I like saying, if you assume that this is the business, this is the business, and this is the owner of the business, this is the owner of the business. Now, whatever we say, we do not mix the accounts of the business with those of the owner. Now, when the owner brings money on board into the business, now it becomes, when the business receives money, the business receives money, those monies could be in the bank, the monies could be in the bank, or even cash in the office. It could be money in the bank or cash in the office, and we call, now the business owes the owner that money. The business owes the owner that money, and what the business owes the owner, we call it capital. What the business owes the owner, we call it capital. So whatever amount that you bring on board, becomes an asset in the farm. It becomes an asset in the farm, but the farm owes the owner. The farm owes the owner. Now, what the farm owes the owner is called capital. When it comes to the farm, it is an asset. It is an asset. It is an asset. And once we get that money, we can now buy other assets. We can buy land with the money. We can buy buildings with the money. We can buy furniture with the money. We can buy plant with the money. Plant is the place where manufacturing takes place. We can even buy something called stocks. The things we buy to sell. We can buy stocks. We can buy stocks. So whatever the owner puts in, he's owed that by the farm. In other words, we are saying, if you bring 1,000 shillings, he will buy things worth 1,000 shillings. And that's why we say capital, assets, we say assets. If the business does not have any other source of funds, the only source of funds is the owner, then you say asset is equal to capital. Assets is equal to capital. The amount that this business owes the owner, called capital, is equal to the assets that the business has. Is equal to the assets that the business has. But at times, this business may want to have more assets than can be funded by the owner. So these are the assets and this is the funding. These are the assets. Where do you get the money to buy the assets from? It is from the capital. What is capital? It is resource. It's money that was provided. It's funds which were provided by the owner. We got the funds, and with those funds we bought land, we bought buildings, we bought furniture, we bought plants. So you may be finding a scenario whereby we have all these assets, but how did we get the funding? Where did we get the money from? We got the money from the owner, and that the money from the owner is called capital. But like we're saying, at times the business requires more money than the owner has, and therefore the business may borrow money from other persons. Money which is borrowed from other person. Assume that we get another gentleman here. We get another, or just a lady. We get another lady here. Now, this lady is not the owner of the business, but she has excess money which she can lend to this business. Now, she's lending. She doesn't own the business, but she's lending. The business will pay interest. She's lending the money to the business. The business will pay her interest. Now, the money which the people who lend money to the business, we call that money liabilities. The money that third parties lend to the business are called liabilities. And therefore, you may now have much more land, more buildings, more furniture, more plant, more stocks, more vehicles, because you are getting more money. So you find you will increase the resources that the farm has as you get more money. As you get more money, now a business therefore can get funds from liabilities or from capital. A business can get resources, can get assets from capital or from liability. And therefore we say the resources that a business have equals to the funding, the sources of funds, equals to the sources of funds, equal to the sources of funds. So we're basically saying that the asset that a business has equals the sources of funds, equals to the sources of funds. The funds that a business has equals to the sources of funds, equals to the sources of funds. Now, we are saying that the assets that a business has, you cannot have assets if you don't have the funds to help you acquire the assets. You cannot have assets if you don't have the funds to acquire the assets. So we say assets equals to capital, the money provided by the owner, plus liability, money provided by lenders, people who lend money to the business. You cannot have assets which you have not gotten a source of funds. You can't have assets if you don't have a source of funds. And therefore, we say asset is always equal to capital plus liabilities. So assets are resources. These assets we say are resources, and then we say are always equal to the sources of funds. These are funds, are always equal to the funds. Assets will always be equal to the funds that you have. Assets will always be equal to the funds that you have. And therefore, we say that we have two different categories of resource assets. We have two different categories of assets, two different categories of assets. We have assets which are called non-current assets, and we have assets which are called current assets. We have assets called current assets. We have, among the assets that a business can have, it is non-current assets and current assets. Non-current assets and current assets. Now, what are current assets? What are current assets? What are current assets? Let's start with non-current. What are non-current assets? These are assets that stay in the farm for more than 1 year. These are assets that stay in the farm for more than 1 year, and they include, number one, land and building, plant and machinery, furniture, fixtures and fittings, and number 4, motor vehicles. These are called non-current assets. They are called non-current assets. Among the assets that you're going to find from capital and liability, they are non-current assets, and they include land and buildings, plant and machinery, fixtures, fittings, and furniture, and then motor vehicles. Now, please notice that these assets are usually arranged in order of permanence. How permanent they are, and therefore you must memorize them in that order. Land and building, plant and machinery, furniture, fixtures and fittings, and motor vehicles. They are arranged in order of permanence. You must put them to memory in that order. Land and building, plant and machinery, furniture, fixtures and fittings, and motor vehicles. They are assets that stay in the farm for longer than 1 year. For longer than 1 year. Land could be there even for 100 years. Building could be there for 50 years. Plant and machinery. And you realize that land is the most permanent. Land is the most permanent. Plant and machinery, they wear and tear and they get depleted. Furniture and fittings, they may not live in the farm longer than the plant and machinery. Then motor vehicles are the ones that are usually in the farm for the shortest period of time. They are called non-current assets. Then we have what we call, by the way, plant is where we do manufacturing. It is where we do manufacturing, and then we always put them together. The building where we do manufacturing, and then we have the machinery which do the manufacturing, plant and machinery. And then we talk of current assets. We talk of current assets. We talk of current assets. And current assets include, number one, inventory. 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 We also call it stocks. We also call it stocks. We also call it stocks. What are inventory? Inventory is whatever we buy to sell. Inventory is whatever we buy to sell. If we buy and sell phones, then our inventory is the phones. If we buy and sell chairs, what is the business item that we use? If we buy and sell chairs, chairs will be our inventory. If we buy and sell clothes, clothes our inventory. Inventories are the things we buy to sell. It's everything we buy to sell. Whatever the business buys to sell, it is called inventory. Below inventory, we talk about trade debtors. We talk about trade debtors. Now, trade debtors are the people who owe us money. People we sold goods to on credit. They are called trade debtors. The people who bought inventory on credit are called trade debtors. They are people who we sold inventory, but they did not pay us in cash. The amount they owe us is the amount we call trade debtors. We call them trade debtors. Then we also talk about sundry. We also talk about sundry, all other debtors, all other debtors, all other debtors. Now, who are sundry or other debtors? Any other person who owes the farm money is called sundry or other debtors. For instance, if we buy and sell phones, but we have some chairs in the farm which we no longer need. We have some tables in the farm which we no longer need. They are not our inventory. We buy and sell phones. We buy and sell phones. But we have some chairs which we have bought new chairs. We want to throw them or we want to discard them. And we get somebody who takes all our chairs, who takes all our old tables and does not pay us immediately. That person, the amount that person owes us is called sundry or other debtors. Is sundry. These are debtors. These are the people who owe us money other than those who owe us money because we sold goods to them. We sold inventory to them on credit. Sundry debtors is any other debtor that owes the farm money other than the trade debtors. From there, we talk about prepayments. We talk about prepayments. What are prepayments? What are prepayments? Prepayments are payments made in advance before receiving goods and services. For instance, when you want to start a business, you may find that your tenant wants you to pay rent for 3 months and deposit. He wants you to pay deposit for 3 months and rent in advance for 3 months. So you're told to pay 6 months of rent even before you get into the house the first day. Immediately you pay that 6 months rent, it becomes a prepayment. You have paid before using. We call it prepayment. They are payments made before the receipt of goods and services. You still owe that money. You still own that money. And therefore, it's an asset. It's an asset. It's an asset. Because you have not used the money. You have not used the money. Any payment you have made before receiving the goods or services is called a prepayment. And it is an asset. It is an asset. Then we go to a place called bank. We go to bank. We go to bank. We go to bank. Now, bank is the money in the bank. Bank is the money in the bank. And then money in the office, we call it cash. Money in the office, we call it cash. Money in the office, we call it cash. Now, the assets of a business are classified broadly into those categories. And this category, we say they are arranged in order of liquidity. They are arranged in order of liquidity. They are arranged in order of liquidity. What is liquidity? It is the ability to turn into cash. It is the ability to turn into cash. So the most liquid asset is always cash. The most liquid asset, the asset you can pick and spend it elsewhere, it is cash. It is cash. Then the one which is not, which is closer to cash is bank. Money in the bank. Money in the bank. Money in the bank are not like prepayments. And prepayments are actually not like sundry or other debtors. Then we come to debtors and then to inventory and stocks. We are saying again, we memorize the current assets. We memorize the current asset in that order because that order is called liquidity. Very soon, we will introduce you to the preparation of something called balance sheet. We introduce you to the preparation of balance sheet, and you will need to remember this very, 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 very much. As you prepare your balance sheet, you must strictly follow that order. The current assets are arranged in order of liquidity. We start with inventory, we go to trade debtors, the trade debtors are also called accounts receivable. Accounts receivable. Accounts receivable. So trade debtors, then we come to sundry or other debtors, then you go to prepayments, then you go to bank, then you go to cash. You will be required to maintain them that way. So the assets that the firm may buy with the funds that you are going to receive from the two different sources, we are saying you buy land and building, plant and machinery, furniture, fixtures and fittings, motor vehicles. Non-current assets, we can also buy the current assets, and the current assets to be bought are inventory, trade receivables, other or sundry debtors, prepayment, bank, and cash. We follow that order. That is the side of the assets. That is the side of the assets. That side of the assets. What about the side of capital and liability? Capital and liability. Now, we have, we follow the same argument among liabilities, and we say we have non-current liabilities, we have non-current liabilities, and we have current liabilities. And we have current liabilities. We have current liabilities. What are they? What are they? Now, non-current liabilities are the amount of money that the business owes to the lenders and will be paid within a period that is longer than 1 year. It is the amount that a firm owes the lenders, people who lend money to the firm, and this money will be paid over a period of more than 1 year. A very good example of a non-current liabilities is loans. Loans. You go to the bank, you get a 4-year loan, and you are supposed to pay that in 4 years. Now, that loan is a non-current liability. It is a liability that the business will pay for a period of more than 1 year. You can even get money from the parents. From the parents. Money gotten from the parents. You could be saying Peter's loan. Peter's loan. We say It is a loan from a dad called Peter. Now, if we allowed to pay that loan for a period of more than 1 year, it is called it is classified among non-current liabilities. And then we have current liabilities. We have current liabilities, and the first current liability in the listing is called bank overdraft. It's called bank overdraft. It's called bank overdraft. What is a bank overdraft? A bank overdraft is an arrangement with the bank whereby the bank accepts to pay more money on your behalf, to pay more people who owe you money on your behalf, more than the money you have in the bank. More than the money you have in the bank. When that happens, you owe the bank. You owe the bank, and the bank charges you some interest. The bank charges you some interest. Now, it means immediately money hits the bank account, the bank will get its own money, and therefore the money will be paid. So it's an arrangement with the bank whereby the bank pays more money than the business has in the bank. And that excess money is a loan. It's a very, very short-term loan, and therefore the bank charges the business some interest for doing that. Then we talk about trade payables. Now, trade payables are liabilities that we incur when we buy inventory on credit. When we sell inventory on credit, we call the people who owe us money trade debtors. When we buy as a business, we buy from suppliers who we do not pay immediately. We owe the suppliers, the people who sell goods to us. Please look at it this way. The suppliers sell goods to us on credit. We get from the suppliers. We receive goods from them on credit. Now, we call our suppliers trade creditors. Then, once we receive the goods ourselves, when we sell on credit, we call them trade debtors. We call them trade debtors. The people who supply goods to us on credit, we call them trade creditors. The people who buy goods to us on credit, we call them trade debtors. And therefore, so one of the liabilities that a business has is called trade payables. The liability that you owe suppliers of goods. So then the other one, we say other or sundry creditors. Trade payables are also called trade creditors. And trade debtors are also called receivables, trade receivables. Now, other or sundry debtors, sundry creditors is any other firm, is there any other amount of money that the business owes people other than the amount it owes to suppliers. The amount it owes to suppliers is called trade payables. Any other amount it owes any other person is called other creditors or sundry creditors. To conclude, I'm just trying to say that assets is equal to capital plus liability. Assets can be broken down into two broad categories, that is non-current assets and current assets. Non-current assets are arranged in order of permanence. Current assets are arranged in order of liquidity. Now, the current liabilities are arranged in order of urgency to pay. They are arranged in order of urgency to pay. The most urgent liability to be paid is the bank overdraft. Immediately money comes to the bank takes its own money. So the one that is most urgent to be paid is the bank overdraft. From there you come to trade payables, and then we come to other creditors or sundry trade creditors. Again, these ones are arranged in order of urgency. These ones are arranged in order of liquidity. These ones are arranged in order of permanence. Now, what you will realize, we are saying assets is equal to capital plus liability. Asset is equal to capital plus liability. We are therefore saying capital is equal to assets minus what? Minus liability. Capital, here these are simple mathematics. Capital is therefore, if you subtract liabilities both sides, you'll be left with the capital this side. And therefore we say capital is equal to assets minus liabilities. Assets minus liabilities. You will say the same. If you wanted to know liabilities, you still come back here, you subtract capital from both sides. So you say liabilities is equal to assets minus capital. Assets minus capital. Assets minus capital. Now this is a very, very, very important equation. It is called the accounting equation. It forms the foundation of accounting. Thank you very much. See you in the next video.